I think there's a strong case for this structure. While our shares are publicly registered, they're not traded on an exchange. That provides a different return stream for investors. And so it's a sector that's continuing to grow. We're quite proud to be leaders in it.
Hello, welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guest today is Allan Swaringen, President and CEO of JLL Income Property Trust, an institutionally managed daily NAV REIT with approximately $6.6 billion in portfolio equity and debt investments. Allan, welcome to the podcast.
Sarah, great to be here. Looking forward to it.
So, Allan, late in 2024, JLL Income Property Trust announced its 52nd consecutive dividend. Can you discuss the broad strategy that's enabled this level of consistency?
Sarah, we were quite the innovator in the NAV REIT space and truly launched this program in the fourth quarter of 2012. But I think more than our history, it's probably most relevant to talk about that we've always viewed our mission and to some degree our investment objectives as trying to be a hybrid investment that in some ways tried to balance the stability of the performance and in the private real estate markets that the NCREIF Odyssey delivers to institutional investors with the same history of consistent growing dividends that public REIT investors look for. And so we really try to balance both of those objectives. And we're quite pleased that over that 12 and a half year history now, we've had 9 dividend increases and 4% annualized dividend growth. We still might lag some of the dividend growth of truly some of the marquee public REITs, and some of those have been out there for 30 or 40 years. So we have a lot of catching up to do. But balancing that hybrid objective of both a private real estate exposure, but in a public REIT kind of corporate governance, we're very pleased with how we've gotten there. And it's really been focused on emphasizing properties that deliver durable and growing incomes.
How would you say fundamentals are shaping up for commercial real estate in early 2025?
Sarah, it's a mixed bag, definitely by property type. I would say broadly, the fundamentals of commercial real estate are generally in very good shape because there hasn't been a lot of new building and a lot of new development over the last 2 or 3 years. Transaction activity has been down and lending has been down. But if I were to break it down by sector, and especially those sectors that we're focused on, industrial warehouse markets, there's been a lot of new supply, but there's also been a lot of take up of new space. And so there's still very strong demand for leasing for warehouse space. And we're seeing deliveries while they're up, new construction is really starting to taper. So we feel good about that. In the multifamily sector, which we have a very significant allocation to, again, certain regions of the country, like the Southeast, had seen some significant building and saw some softness and weakness in the Southeast apartments, but absorption is grabbing that. And right now, there's record low new construction. And so if you look out 2 or 3 years, the fundamentals of the residential sector are very strong. We also have a healthy exposure to grocery anchored retail, and that has really seen very little new construction over the last, really since COVID. Open air retail continues to perform without a lot of new supply, and absorption and rent growth being quite strong in that sector.
And can you talk about the outlook for real estate debt and how that plays into the broader investment picture today?
So the real estate lending community has definitely pulled back. We had the challenges a couple of years ago with some of the regional banks, and a lot of the regional banks are often big real estate lenders and provide a lot of construction lending for new construction. So that's tamped down new supply. The securitized debt market is recovering, but it's still not near its peak. Broadly, actually, the lack of real estate debt has been opportunity for us. And within our portfolio, we started allocating to a private real estate credit allocation. Today, it's about 2% of our fund, just shy of about $150 million. But the higher interest rates and the higher spreads have actually made what we believe actually the real estate lending environment probably some of the best risk-adjusted returns an investor can achieve today. So we're looking to grow our allocation to private real estate lending, loans we originate, borrowers we underwrite, and properties that we would be willing to own. It's certainly not a loan to own strategy, but there's a significant amount of debt maturities on high quality, leased and well occupied properties that are looking for bridge financing to get from here to lower long term interest rates. And we're able to lend to that community at very attractive spreads and a very attractive total return to our dividend yield. So it's probably one of the most accretive investments we can make right now is increasing our private real estate credit allocation.
And Alan, you've touched on supply issues already. Can you talk a little bit more about the opportunities that you see that creates?
Listen, there's probably the most challenged property type given the supply and demand fundamentals is office today. We're significantly underweight to office across our $6.6 billion portfolio. We only have a 3% allocation to office, really only own 3 office buildings. We think the office market is going to continue to be challenged for a while. So it's a sector that we've significantly underweighted. Overweights for us have been residential, both apartments and single family rentals. We have a very healthy allocation to single family rentals. That's a market we like. We like industrial. It's about 32% of our portfolio today. And then across the board, we continue to try to be very diversified, both property sector and geography versus being focused in one single market or one single property type.
And I wanted to ask you a little bit more about that in terms of which geographic markets you might be particularly interested in right now.
So, from a geography standpoint, we do what I would say is really a lot of kind of bottom up underwriting. So, in the warehouse sector, we really focus on markets what we consider, often call them hubs of transportation. So, if you look at places in the United States where there's significant transportation infrastructure that's been built, highways, interstate highways, rail spurs, airports, and seaports, and ideally maybe 2 or 3 of those confluences of transportation have generally been very strong markets, both in strong markets and then even weaker markets, those hubs of transportation, especially when they're overlaid with densely populated areas. So that's been a focus for us on the residential side, both apartments and SFR. Again, when we look at geography, we're focused at the very micro level and really have been investing for the last 5 or 6 years in areas where there was highly rated school systems. Really good elementary, middle school, and high schools are great areas to own apartments and own single family rentals. They tend to have kind of a moat of competition in terms of new development because oftentimes there's NIMBYism in America and it becomes somewhat challenging for developers to build high density apartments in these areas that have high school districts, have very good schools. Similarly, you also tend to get higher tenant retention and tenants stay in those areas versus one specific geography. We're really focused in kind of the underlying fundamentals of each of those markets, whether it's location for transportation, for industrial, or whether it's local school systems. For retail, we very much focus on areas that have good household income, growing household income, and growing population density. We're probably not one of those investors. We're probably focused more on infill markets and owning what we own versus kind of path of growth markets.
And Alan, as chair of Nareit's public non-listed REIT council, what are some of the main issues you expect to be focusing on this year?
So listen, I hopefully you'll indulge me. I'd love to give a shout out to Steve Wexler and Penny Rostow, who work on that committee with me, and also Kurt Walton does a ton of work. And the reason why I talk about their work is because as the chair of the PNLR, something I'm quite proud to serve as, and also reflecting on kind of what NAREIT's kind of responsibility to their members are, we've really been working for a very long time on trying to not make the case for public versus private, but to really do foundational work that publicly traded REITs and private REITs like the NAV REIT sector, they're not an either or, it's a both. And Kurt does a great job with that in his education. And so I think one of the priorities we hope for 2025 and beyond is making the case to investors that there's a spot in client portfolios, whether they're institutional clients or whether they're high net worth clients. There's a spot for both REITs, whether they are listed on a stock exchange or whether they're invested through financial advisors like our program. There's really a case for both of them. And it's not an either or. And I don't think you should be comparing investment performance of one structure versus the other structure because something that's traded every day, every minute of every day is going to always perform different than something that's valued quarterly like our program is. It's really about trying to educate investors and advisors that both of these solutions can be very complementary and can enhance portfolio performance over the long term.
And finally, any other trends or developments in your sphere that we haven't had time to touch on already?
The one thing I would say is the NAV REIT sector, which is, again, we helped found it about almost 13 years ago. It's continuing to take hold, it's continuing to grow. It's a sector that we think has good fundamentals. Our performance has been very similar to the institutional Odyssey type index, the NAREIT index. You're starting to see property specific NAV REITs, property sector specific NAV REITs. I think there's a strong case for this structure. While our shares are publicly registered, they're not traded on an exchange. That provides a different return stream for investors. And so it's a sector that's continuing to grow. We're quite proud to be leaders in it. And I'm really pleased to work in partnership with Nareit to continue to educate folks on the opportunity set for the NAV REIT sector.
Allan, thank you so much for your time today.
Thanks, Sarah. I really appreciate your time and our partnership with Nareit.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe on your favorite podcast platform.